Welcome everyone to today's session, which is focusing on an introduction to BetterLabs Ventures. It's part of our virtual event series here at Insurtech Australia, and we're really pleased to be presenting this to you today in conjunction with our partner RAC. So I'm just giving everyone a few minutes for participants to log in and join us, which I can see is happening fairly rapidly. For those that don't know me or haven't met me, I'm Rita Yates, the CEO of Insurtech Australia. And as I mentioned, it's a real pleasure to be here with you today. Now, we know that as a startup or scale up, raising capital is always really difficult and an absolute challenge. But in the midst of a global pandemic, and from what I just read, Australia is officially now in recession as of this morning. Things are all the more challenging for startups and scale-ups looking to raise or needing to raise capital. This is part of the reason we have chosen to focus a stream of our virtual events on investment and raising capital, obviously. So we did run an event last month, and both that event focused on investment trends globally, and this event also has had a really great response rate, so very, very positive to see that. So as you're all dialing in and logging in, we're actually going to launch a poll which will give us a little bit of information about whether your organisation is looking to raise capital in the next 12 months. So the poll should pop up on your screen shortly. And what we ask you to do is just register a yes or a no answer. This will give us just a bit of an idea of how many of you in the audience out there, as I said, will be looking to raise capital in the near future. So we're going to keep that up on the screen for about a minute or so, just to give you a little bit of time to respond. As it's up there, I'm going to keep chatting away. So just thought I'd mention a little bit about our events that we're holding next month in July. We have two major events occurring. The first one is actually the launch of our Insurtech Ecosystem Report for 2020 in conjunction with EY. We'll be doing a launch event around that period of time. So I hope to see you all as part of that. And the second event will be for the DXC Insurtech Invitational Competition, and it will be a pitch event for the finalists, focusing on having a look at who the finalists are as part of that competition. So we hope to see you as part of those events coming up. So just going to keep that up on the screen for another 10-15 seconds. We also held a great event yesterday with our global Insurtech Alliance partners across the Asia-Pacific region, Japan, Asia, and New Zealand, as well as Australia. And it was the first of a series of global Insurtech Alliance events that did go really well. So we're looking forward to running a number of those in the future. Okay, so thank you for responding to the poll. For those of you that have, it looks like for those that responded, around 56% of you are looking to raise capital over the next 12 months. So that's important to know. And hopefully you'll hear some things today that might be interesting to you. Okay. So just a little bit about how today's session will run. So we're going to hear a 40 to 45 minute presentation from the BetterLabs team. There will be Q&A at the end of that. Please do post your questions in the Q&A portion of the screen down the bottom. You can do that whilst the presentations are occurring or towards the end as well. We'll run that for about 15 minutes. Hopefully we get lots of questions from you. We do want it to be interactive. And then we'll close within the hour. So before we actually get going, I do want to thank our long-term partner RAC for your support, not only in this event, but your ongoing support of the Insurtech ecosystem. It's a really valued partnership that we have with RAC. Okay, so I am going to hand over to today's speakers. Before I do that, I'll just give a brief introduction to BetterLabs Ventures, which is the corporate venture fund for the RAC WA. The RAC WA, or RACWA as some call it, is the motoring club and member organisation with over 1 million members, providing insurance, roadside assist, finance, travel, parks and resorts, and it is the most valued brand in Western Australia with around a $1 billion balance sheet. So BetterLabs Ventures was launched in September 2018 as a $3 million seed fund and recently expanded to $23 million, covering seed and Series A and B. To date, they've had 205 applications, made 4 investments, and they have 4 further currently in due diligence. So presenting today on behalf of BetterLabs Ventures is James Edwards, the CEO of BetterLabs, and Derek Gerard, the entrepreneur in residence. So I'm going to hand over to Derek and James now.
Great, thanks Rita, very much appreciate the introduction there, and thank you for taking the opportunity to host us today. I'm just going to try and share our presentation, which should come up. Can everybody see that okay?
Yep, that looks good.
Great, got a thumbs up, fantastic. So no, thanks for the introduction, Rita, and Derek and I will just run through our presentation around BetterLabs and give you plenty of time for some Q&A at the back end of this. Just briefly on who we are. So I'm the CEO of BetterLabs. So I've been in this role for about 18 months. I've got an engineering background, and the last 12 years prior to joining BetterLabs, my main role was with the big 4 professional services firms looking at innovation funding for large corporates from Rio Tinto and Shell all the way down to startups in a variety of industries, including tech, insurance, agribusiness and resources. Derek is our entrepreneur in residence, and we'll give you a bit of a more detailed intro himself, but he also manages the fund on our behalf. And Kate Warren is our commercial manager. Kate's been with us just clocked over 10 years, which is great, and 2.5, well actually 3 years with BetterLabs, and has a lawyer background. So just in terms of what we'd like to cover, I'd just like to briefly run through how BetterLabs Ventures fits into the wider RAC WA innovation program. I'll then hand over to Derek, who will run through what investments we are looking for and give some tips and tricks on how to put your best foot forward in terms of an application all the way through to hopefully a final investment. And then, as Rita mentioned, we'll have some Q&A, which we can do via the chat channel. So RAC, so Rita stole a bit of my thunder in the beginning there in the intro, but look, RAC has been around since 1905. So we are the oldest motoring club in Australia, and we've been very successful. We cracked 1 million members in WA. We are in 1 in every 2 households, and we have a very well recognised brand in the market. Financially, we do have a $1 billion balance sheet. In fact, last year we did have our most successful financial year on record, which is great. So why the need to innovate? Our prior CEO and my predecessor about 5 years ago recognised that disruption is coming to motoring clubs. And part of this disruption is what you can see on the page there, autonomous vehicles. So RAC, most of our revenue is generated through our motor vehicle insurance. And as you can imagine, with autonomous vehicles, there's going to be less accidents going forward, and something to make sure we are robust against this upcoming disruption. So part of this was really around looking at where we wanted to play. So we needed to innovate, but where did we want to innovate? So we did do a whole bunch of future scenario planning around looking at where do we see Western Australia, Australia and the global community in 2030 and beyond. And dropping out of that, we identified what we call our emerging innovation domains. Think of these as swim lanes of where we, the RAC, would like to invest our resources and time and money in identifying and hopefully exploiting transformational innovation opportunities. And Derek will go through these a bit later on in more detail, but we're looking at clean tech, which is around energy, waste and water, life, work and money, which is really around the future of how we're going to live and work and money. So think of co-living, think of shared economy, think of digital currencies. Member community, how we can extract better value for our members in the community. The third, age, that's how we can see business opportunities in the aging population. Next gen insurance, which is obviously very relevant for today. New business models, new technology that's going to influence how we insure ourselves going forward. And then finally, obviously for Motoring Club, mobility of the future. What does that look like for us in Australia? So these really inform where we'd like to invest our resources and time in identifying new business opportunities for RACWA. So the next question really is, how do we do that? We know we need to innovate. We know where we wanted to innovate, but how do we do that? Some of you might be familiar with this slide. It's from the Boston Consulting Group's Corporate Innovation Toolbox. And it really outlines 3 or 4 major areas where corporates can innovate to get some return on their investment. So M&A is obviously where we can go out and acquire new capability, new businesses. Internal R&D is where we're looking at long-term return on projects such as, think of the motoring industry, pharmaceutical industry. We've got long time frames in terms of developing new products and resources. And the other 2 are corporate venture, where we look at taking equity stakes in startups and looking at a return on that, and then internally prototyping of new business ideas. So really the focus for us at BetterLabs is around the corporate venture side and the internal prototyping side. What we did at RAC is we realized to give this this function every chance of success, it was actually spun out into a separate entity. It was provided with very streamlined governance processes and purchasing authority processes, etc., to make sure it can run as fast as possible. And then it was given the mandate to explore the corporate venture side and internal prototyping side. So on the corporate venture side, as Rita has mentioned, we officially launched that in September 2018. It was received very well in the community. Initially, it was a $3 million seed fund, and that was recently expanded as of January this year to a $23 million seed Series A and Series B fund. So the primary objective of this fund is really looking at those investment opportunities in predominantly Australian startups. We will look globally if need be, in those emerging innovation domains, those 6 emerging innovation domains. And so far we've had great traction, as Rita has again called for. We've 207 applications, 54 pitches. We've actually just signed a term sheet earlier this week, which is fantastic news, and looking to close our 5th deal in the upcoming few weeks. Some of the deals we have done are with Power Ledger, which is a blockchain electricity sharing play. Space Deco, which is a WA-based startup, is an online marketplace for sharing commercial space such as restaurants and cafes, which is great. Complete Home Filtrations is a company that provides all of home filtration, but is developing a special technology to filter out PFAS, which is the firefighting chemical that gets into groundwater and cannot be removed. And we've also invested in the +8 accelerator program, which is run by a co-working space here in WA, which takes around 15 startups through an accelerator program over a few months, and then we invest in those final cohort, which is great news. So great news to date. I will now hand over to Derek, who will introduce himself and just run through our application process, what we're looking for, and some tips and tricks. Thanks, everybody. Derek.
Thanks, James. Hi, everyone. Thanks for joining us today. Just briefly, my background, just so you understand, I've been in the technology industry for over 20 years, and that started back in what was called, I guess, the .com era. We kind of say startups now, but back then there were .com companies, and did that with PricewaterhouseCoopers in America, New Zealand, the UK. But probably more recently had my own startup business called GreenSense, where we did real-time energy and water monitoring for commercial buildings. And we went through a few rounds of private equity funding, and then eventually sold that to a electricity company called ERM, ASX listed, that's just been acquired by Shell actually. And I just kind of share that story for those of you that are founders and have your own companies. I guess just sharing that experience of knowing what it's like to be in that hustle and grind of getting something going and trying to raise capital and all the things that go with that. We were fortunate in some ways to have the journey where we got to exit, which was great. So since then, I've set up a private equity group called Go Capital, where we're investing back into technology startups. I also sit on 7 boards and help technology companies scale. Entrepreneur in Residence for the +8 program that James was mentioning, and then obviously Entrepreneur in Residence and managing the fund for BetterLabs, which is what we're here for today. But anyway, just a bit of background there to help. So what we're going to just chat about now is the kind of things we're looking for in an investment profile. And if you're looking for capital, you can line up to see whether this is something that you think you fit with. At any point, by the way, and we'll send out details, I think Rita's going to send out, but I'll drop it into the chat a bit later on, our website, betterlabsventures.com.au, which has most of this information on as well if you need to revisit, and that's also how to get in contact with us. So I guess at the outset, we're talking about this idea of problem solution fit. And what we mean by that is that you're not just building something and then finding a problem to solve. It's really come the other way around, where you understand who your target customer is, you know that they've got that problem, and you validated that they would be prepared to pay to have that problem solved by virtue of the product or service that you're offering. And so we're looking for clear evidence of that. And typically the best evidence, which I'll talk about when we come to traction, is actually a paying customer. Obviously, we're here looking for businesses, and really the proof of that there is a business model that works is you've got a customer who has paid you. And once you've got one customer paying $1 for whatever it is that you're selling, it actually de-risks some of your business model, because some of the assumptions that might be there right now, if you haven't got to that point, start not becoming assumptions, but reality that we can have some confidence in. So definitely being able to clarify your problem and solution is important. We're investing in innovation. So interestingly, we find, and certainly a lot of things I've been involved in, that there's some companies, and I'm thinking like SpaceX here, which are so far out there in their innovation, whilst it's really exciting, the reality is return on capital might not be for 20, 30, 40, 50 years. And whilst that's really exciting, I guess when we think about innovation, we're looking at what are the things that are just a couple of steps away from where we are right now. So we know there's actually a business model that can start working and that. But innovation, often we just think about technology. But I think innovation is much broader than that. So we think about, obviously technology is part of it, but your innovation could be around customer experience, it could be around your pricing or business model, it could be around some operational efficiencies. There's all different ways that you might have built innovation into your business. But ultimately what we're thinking about when we look here is what I would describe as the concept of defensibility. So in other words, as you build market share, how are you going to defend against either the incumbent businesses currently solving those problems or the new entrants? How do you defend the market share that you're winning? And sometimes that's not always obvious. You need to think out of the box a bit when it comes to that. A little story I like to share that you might be familiar with is going back to when Apple launched the iPod, the original iPod. At that point in time, you may recall that Sony really owned the personal music device player. They'd had the Walkman and they had the mini disc player, and really that market shouldn't have been disrupted. But what Apple had done had, and there's many things that sort of contributed to their defensibility strategy. The iTunes store was one of those, but the one I'm thinking about here is that once they'd worked out how to get MP3s onto something as small as the iPod, they actually went and bought up the world's supply of the hardware. So by the time Sony realized they couldn't actually develop and build the same product, and that gave Apple a 12-month head start, and I guess the rest is history, where they suddenly own that market. So I guess just sharing that story, because defensibility can sometimes be a bit out of the box thinking. It's not always around a patent or brand or first to market or these types of things that you might obviously think. Next point for us is around a global market. We're actually mostly interested, to be honest, in backing Australian-based organisations that potentially have global reach. And I say potentially because there's some amazing organisations that only need to service the Australian market and can grow to a size that's really interesting. But obviously, if there is global application and it makes sense for you to go into that global market, then we're interested in that as well. My experience with that is that though every time you go to a new geographical market, people usually underestimate the time it takes to land in that market, to understand what the price point is, to maybe adapt to a slightly different culture, language set. And so, you know, if you are going to other countries, it's important to make sure you've considered some of those things. But, you know, for us, a business that's might actually only get to 10, 20, $30 million revenue over a few years could actually be really exciting in terms of an exit, looking at our investment profile and what we'd like to see in terms of return on capital. And you can definitely do that in an Australian market. That said, we think the entry point needs to be a business that can demonstrate over its first 2, 3, 4 years that you can at least get to about $10 million a year revenue. And we only say that because often we do have people that are smaller businesses that might be making a few $100,000, which is fantastic and a great provision for the owners of that company. But obviously for us in terms of investment profile and venture, it's not the right fit. So we just like to clarify that. Next thing is the founders, and of all of the things that we look for in all the investments I've ever done, and certainly we've had this validated in what we've been doing at BetterLabs, if there's only one thing that we could pick that is the most important, is what we would describe as the founder team. We're really in an early stage investment portfolio backing the founders, because actually the reality is right now it's unlikely that all of your assumptions are right. In fact, I go as far as saying that probably 90% of what you think you know about your business in the early stages is wrong. And it's not that you're meant to know more than that, it's just the nature of a startup. And it's that discovery of really finding that customer solution fit, and it's the pricing iterations and your best go-to-market channel and those types of things. And so we appreciate that that's all got to evolve, but what we need to do is be backing the right people to make sure that you've got the expertise to go through that journey. And so in the founding team, we're ideally looking for co-founders. We have invested where there's been a single founder, but ideally we think 2 or 3 is a better fit, just more heads around the table. And usually that's because you need the spread of both industry, technology / sort of product, and then commercial skills. And it's very rare that you find all those things in one person. So it's about making sure you're filling those gaps in your founding team. I would suggest that the due diligence you do on your investors should be the same that we would do on you as founders. And there's a little kind of tool, I suppose, that we've got that we always have in the back of our mind when we're starting that journey of relationship and getting to know each other. And it's what I call the 3 C's, which is character, competency, and chemistry. And this is kind of how we do it at the first pass of whether we think we're going to have a great relationship with the founder. And what I mean by that is character is making sure the people that we're working with are honest and have integrity and are transparent. As I said, things are going to go wrong with the startup, and we need to know that you're going to be able to front up and be honest about that. And that's actually not because we want to catch you out, it's because we want to help. Once we've invested, we can add a lot of value to your business, and some of those things that you get stuck with, we'd love to be able to get involved and help you resolve. So we need to know there's going to be honest conversations about that. Competency is some level of proof that you know what you're doing. Now, that doesn't mean you have to have run a startup before, although if you have, that's great. And even if it's failed, that's okay, because there's lessons learned from that. But what we are looking for is maybe you've had success in a previous job, or you've come out of the industry and you've been able to identify that problem, or something like that you can talk to from a competency perspective. I think both character and competency we can all develop as we go on in our life. But this final one, chemistry, is really around just that kind of energy that comes from, hey, we get on and we know we're going to do life well together, and there's the contribution of all of us together are better than any of us in our own right. And so the chemistry that sort of comes together when that happens is that kind of wow factor, I suppose, that we're looking for. And you know it when you sit down and you're having a coffee or a beer with someone, it's like, yeah, this just works. And that's something that's pretty important as well. So we're looking for that in our founders. I suggest you need to be doing a similar thing with investors that you bring into your business, because the reality is not all money is good money. And the moment that you've taken some investments, most dollars come with some sense of agenda. They're not just backing you because they love you and it's a great idea. They want something out of that, and you want to make sure you're aligned. And probably more often than not, I've seen people take a check that they shouldn't have done, and it takes them on a trajectory that then actually either kills the business or makes it difficult to take it where you want to. And the reality is, if you're building value in a company and it's the right people with the right product at the right time, you'll always be able to find capital. And hopefully for some of you, we might be that pathway. The other thing I'd say about the founding team is that we would like you to be full-time focused. That's a non-negotiable for us, basically. It's hard going to get a startup to a point where it's generating the right size market and business. And if you've got other things going on, we just know you can't get there. So please make sure that that's what you're focused on if you're going to apply for funding for us. Next one is traction, which I touched on before, but ultimately we're looking for proof that customers want to buy your product. Now, sometimes that can relate to downloads or daily active users or these other types of measures, but nothing beats, as I was saying before, revenue. One customer paying $1 is better traction, I think, than perhaps anything else. And too often, again, we've seen businesses that are offering a freemium model, or they might be offering their product for free or low-cost pilots. But the reality is you're not actually testing then what the pricing opportunity is in that. And so that becomes an assumption. So to be able to de-risk that by going, actually, we've got a paying customer, that's the best type of traction that there is. There are certainly cases where we will invest pre-revenue, and we've done that. In fact, the term sheet that James alluded to earlier is a pre-revenue company, but there is a very, very clear pathway to revenue for that business. And the founders have run a similar type of company before, which they had an exit from. And whilst their product is only just about to launch, they've already got 1,400 pre-subscribers. And so, yes, it is pre-revenue, but there's a clear pathway to revenue. I mean, ultimately, we're not investing in ideas, we're investing in businesses, and ideas are easier than the execution of a company. The final thing there is what we've written down is value. And there's a whole kind of a bunch of different things, I guess, we mean when we say value. The first is let's talk about valuation, right? We are looking for realistic valuations. And a lot of people say they think it's difficult to value a startup. And I don't subscribe to that at all. We have a method that says, okay, we're happy to apply a certain level of value based on the progress that you've made to date. Think about it as milestones. So if you've got a product launched, we attribute some value. If you've got a great team in place, we attribute value. If you've got your first sale, we attribute value. And so we can build up value based on where you've got to. And then at some point in time, we're investing. And part of that is agreeing to a business model that you then understand. Now, that business model probably has lots of assumptions in it. And depending on how many might determine the discount rate we apply to that model. But effectively, the day we invest, we've all got to agree that this is where we think the business is going to head. And once we've done that, we can actually take that model, which hopefully has also got some blue sky thinking in it as well, and we can bring those numbers back into today's terms. And so between your progress and your planned future, there's a number that probably makes sense in between those two things. And so we're happy to have a very transparent conversation with you around that. Again, we've just seen too many cases where people come in and they've seen some crazy valuation in the US that they're trying to align to from a comparative metric perspective, which doesn't translate into the Australian market necessarily, or the comparison numbers are not right, and that doesn't make any sense. And sometimes they're trying to go too high too early, and we actually want to get on a journey with you. We're an investor that can follow on. So again, from that value perspective, the lowest check size we've written is $250,000, and we can do up to $3 million through the fund. So for us, we love to get on that journey of being the seed investor and then follow on in your Series A and Series B. And so getting that valuation story right at the beginning is pretty important. As we do that, we're typically looking for somewhere in a vicinity of a 10 to 20% equity position. And by virtue of that, you can immediately reverse engineer everything I've just said to think about the valuation metrics that we're probably looking for in terms of the actual value of your company. But the reason for that is we're really backing the team and the founders. We will typically take an observer role on your board to assist and provide some governance, which we think adds a lot of value. But ultimately, we're backing you and your team. And so if we end up with sort of more than 20% and something goes a bit pear-shaped, the onus will be on us as the largest shareholder to maybe jump in and deal with that, which is not really our model. It's about backing you. But likewise, because we're investing early, if we come in lower than 10% in that first round, if we don't follow on, it's likely we're going to get diluted to a point that doesn't make a lot of sense for our investment thesis. So that's kind of what we're looking for. So you can figure that out. If you're doing a seed round and you're trying to raise, let's call it $500,000, we're going to be looking for a 10 to 20% position. We could probably do that whole round for you. And by virtue of that, we're going to probably value your business somewhere around the $3 to $4 million mark, as long as it's met some of those things that we've talked about before. The other thing about value, by the way, is just thinking around what other value can we provide other than the cash. Typically, James or I make ourselves available to be part of your board, and we've got different backgrounds and experience that can add value to that conversation. RAC in WA has 1 million members. We definitely can't open up that 1 million member database to you on day one. But obviously, if you are a product that aligns to member benefits that we would typically offer, then as we get to know you and you start delivering on your business plan, that's certainly a channel that we can consider how we open up for you. So value is beyond just the dollar itself, and we'd love to talk about that. So perhaps if we'll just jump to the next slide. The other thing that's on there in terms of what we're looking for, of course, as James has said, is you need to be in one of those emerging innovation domains. Typically what that says is if you're in mining tech or med tech or ag tech, we probably won't have a look. It's not really a fit for us, but almost anything else we'd be prepared to have a conversation. So we have a pretty structured process in terms of how we run our investments, and so that begins by application. So you can do that on our website, betterlabsventures.com.au, and what we can't do, unfortunately, is take coffees with people before you're ready to apply. So hopefully today's session gives you answers to the questions that you've got, and certainly let us know at the end of today. We do run other dedicated information sessions that you can jump online as well, but most other things are on our website. Just because we have so many applications coming in, we really don't start that dialogue until you've applied. If you apply and don't get through it, it's not like it's a one-off hit. So typically we'll try our best to give you feedback as to why it's not relevant, and if things change down the track, you're welcome to reapply again, but that's our starting point. That application should take between 10 and 15 minutes if you're organised, and it's asking questions around the things that we've already talked about. So who's the team, how much money you're trying to raise, what's the problem you're solving, where's the tech at, what's the competitors look like, and the things that you'd expect. If you put an application and we feel like it meets our investment thesis, then we'll invite you to come in and pitch to James, Kate and I. We give you an hour for that. We'll do it online as well if you're on the East and we can't find a way to meet. And really what that's about is just the face-to-face version of the story that you've already given us. It's really important to us that your pitch is consistent with your application. And it's interesting how many times people have come in once they realise we might be interested, and suddenly they change their pitch, and typically they're asking for more money. And that's usually an indicator of those 3 C's that we're talking about, because either you've got greedy because you think we might want to invest and you're asking for more, which is a character issue, or you've gone, well, we're changing our business model, so we need more money, which is probably a competency issue, because it's normally only about a week between when you apply to when we let you know that you can come in for a pitch. So just please make sure as best you can, unless something significantly changes, those things are consistent. So once you apply, we would get back to you within a week as to whether you're going to be able to come in for a pitch. Once you pitch, again, there'd be a week turnaround before we let you know whether we'd like to progress. And if we do at that point, we would sign an NDA at that stage. So this green request for information is basically good to think about that in terms of preliminary due diligence. So we'll be asking for shareholders agreements, business models, key contracts, all the things that you'd expect. And once you've given that to us, we normally take about 2 weeks to review that. Once we've got there, if we think things are starting to line up and there's a really good fit from an investment point of view, we'll have a dialogue around the terms that we're likely to offer. And here we're talking around dollar amounts. A few things are on our term sheets, which are pretty standard and not too onerous in terms of other venture funds that you might deal with, but just a couple of rights that are there, things like liquidation rights. And sorry, tapped my mute button as I was talking there. And we'll verbally agree that, but we can't then offer a formal term sheet until we go to an investment committee meeting, which we have, and that gets signed off. And at that point, we can formally present you with a term sheet. Of course, you're going to love that deal, so you'll sign that document, and then we'll go into some final due diligence, which is mostly around our closing documents, subscription agreements, making sure the shareholders agreement is consistent with the terms and things like that. And then from that point, we would make the investment. So if everything goes to plan, we could get through that in what might be about 2 months. In reality, there's often things that pop up and things that we've got to work on with you and things. And as best we can, we try and be transparent. If you drop out at any point along the way, we'll let you know why. Most of the investments we've done, by the way, people will come, we'll get into due diligence, and there'll be 1 or 2 kind of key things that aren't quite right. And it's not uncommon that a startup's not fully investor ready, but you don't know that till you start talking to investors. And most of the companies we've invested in have actually gone away, resolved those things, come back, and we've invested. And of course, that's a great signal that you're a coachable founder and you're listening, and we can actually work really well together. So yeah, I think that's probably all on the process. I think we're ready for some questions. Is that right, James? We've got the next slide. I'll just double check I haven't missed something there. Yeah, that's right. So
That's it.
that's high level. So yeah, maybe Rita, back to you, and we can take some questions and go from there.
Great. That was great. Thank you, Derek and James. It gives a really, really good background and overview of the way that you run the fund and how the process works, which I think has answered probably some of the questions. We do have a few questions coming in, but one that I actually wanted to pose to you was actually around the current climate and COVID-19 and whether for you it's actually BAU or have the brakes been put on in any way in terms of looking at investments. How has it just overall, I guess, affected the way that you're running things?
Yeah, no, it's a great question, and I probably should have covered that one, but yeah, it's a good question. Look, so we're definitely open for business. As we've said, we put out a term sheet last week, which will hopefully get signed in the next few days, which will be great. But all of that said, we can't move forward without applying a COVID lens to the investments that we've got. So for now, it would definitely be in your interest to come in and think about at least a slide or some thoughts on how your business is relating to COVID. A couple of things I will mention. We did have a company that we literally were about to invest in as the lockdown happened, and we had to pause that investment because they were going to be dramatically affected. And which was a really hard thing to do. We didn't want to do that, but everybody understood, and we're still meeting with that company every month to help them get through. And hopefully, if they do, we'll be able to pick up the investment conversation. But I make that point just because we're not really about survival capital, we're about growth capital. So if you feel like you're going to try and raise money because you just need to get through the next 6 or 12 months, and you're trying to dress that up in an investment story, we'll see through that pretty quickly. So we genuinely need to know that it's a growth story. Of course, there are some businesses that this has presented new opportunities for them and pivot opportunities that need to be funded. And again, we'd be happy to consider that as well. The other thing you probably need to just be aware of is that COVID has affected pricing and valuations. So again, because there's a lot more uncertainty, perhaps some of the valuations that we've seen, which I think, to be honest, we're starting to get a bit more of a bubble effect again around the world in tech companies over the last few years, we probably find that the pricing of those valuations starts softening a bit as well because of COVID. So.
Mm-hmm. Are you, I guess off the back of that, are you interested in looking at potential propositions that look at what the world post-COVID is going to look like within the realms of the areas that you're actually looking at investing in?
Yes, although I guess I'd say no one knows at the moment. So someone that's trying to sell us a business proposition of what post-COVID looks like is, taking a guess, aren't they? Like, I guess we don't really understand what's going to happen. So I think we'd be more inclined to back a business that people understood, they've stayed to their core, and they know that at some point that market's going to shift, and it's an industry they understand. Of course, we're all in that boat a bit, which is, I think, more around how the pricing gets impacted. But certainly if someone came with some ideas of the future, I'd be pretty skeptical that they know what's going on. But it's interesting. We've had companies we've been dealing with, and I'm sure everyone's in similar boats, where literally their forward revenue, I mean, the Space to Go company is a good example. I mean, they're all about events bookings. We've invested in that company, and literally overnight, every forward booking they had got cancelled. And so we've just had to, help them get through that and make sure they're here on the other side. And that's kind of really important. There's another company I'm involved in, which happened to have some software that was developed for medical trials, and it was managing the relationship between the medical researchers and the patients. And one of the hospitals picked it up to use it to track their COVID cases. And then the World Health Organization picked it up and is using the software around the world. And so suddenly they're going gangbusters for something they'd already launched last year. And of course that needs funding and help and support. So those type of things, might be really interesting opportunities in the short term.
Okay, great, thanks. Moving on to some of the Q&A, and please do pop any questions into the Q&A that you have. So there's a question here around traction, and it is, what level of traction were the investments that you have already made which might be a little bit tricky to answer specifically, but might be able to give general overview.
Yeah, so as I said, I mean, we're definitely looking for proof that it's proof that you understand who your customer is, that they've defined the problem is that you're solving for them, and that they can validate your product or service solves that problem, and ideally by virtue of demonstrating that because they've paid you some money. That's kind of what we're looking for. The investments we've made, Power Ledger, when we invested, didn't have any revenue at that point because it's very, very early tech. It was looking at peer-to-peer energy trading and Bitcoin. So we were very much investing into what we thought was an industry trend. Something like complete water filtration was a product that was already selling. And so our capital was coming in to really accelerate a model that we knew worked. That business literally has 4 times its revenue in its first year and then 4 times again in its second year, and is amazing. And, you know, obviously the revenue is proof in itself. The one that we've just put a term sheet for, as I was alluding to in the presentation, they are pre-revenue, but the founder has had a previous startup in the industry. It's a fintech company, and he's exited that company 3 or 4 years ago. So we know there's ability for him to scale and get a company to exit. They're building their product, which actually gets launched next month, but they've already got 1,400 pre-subscribers for that product and 180 trialing it at the moment. It's a B2C fintech product. So again, it is pre-revenue, but I think, you know, again, we can see that there's some level of traction there in terms of the pre-subscribers and proof. So yeah, so look, it's not a one-off answer that's the same every time. It's case by case, but certainly that gives you some examples of what traction might look like.
Yeah, I think that helps. There's a question here around timeframes, which I think you actually did answer, which was around timeframe from initial application to close of successful deal, which could be 2 months, but depending on if there's alterations required or more information required, could be longer.
Yeah. Yeah. So definitely in those early phases, it should always be from when you've applied, you should hear with us within a week. Once you come in for a pitch, you'll hear with us from a week then as well. So you always know in that early stage. Being an entrepreneur who was raising capital before, for me, the worst thing is when you're talking to investors and it's like a black box. You don't know what they're thinking and they don't get back. You don't know, is it appropriate for me to reach out? Am I going to annoy them if I do? And it's just a horrible vibe. So, you know, we're preferring to go the other way and try and be upfront with our communication and be transparent with that, albeit sometimes that means you find out earlier that we're not progressing, but we'll try and help with that. The other end of that all depends on how, what I would say, investor ready your company is, or making sure your business hygiene is in order. Because often once we get right into the nitty gritty of getting ready to make an investment, if your shareholders agreement's got some funky terms in it, or your cap table's not right, or you've got, you're thinking of putting in a ESOP and you haven't done that yet, there's all these kind of things that if they haven't happened, you're going to need to do them before we invest. And then it's usually that drags out the process, not because we go slow. So if you do want to go fast, the best thing is to come in, have all the documents that you need in place, have your cap table sorted, have your business model sorted, have your shareholders agreement sorted, those kind of things, and that makes the process go much faster.
Yeah, great advice. Okay, the next question is actually around NDAs, and the question is, how do we apply with our business model and protect our IP without getting an NDA signed prior to initial discussions? And this is actually a question that does come up quite often. I'm sure you have heard it many times before, both Derek and James. So yeah, interested to hear your input on that.
Yeah, no, for sure. I mean, a couple of comments on that. The first is, as a venture fund, we see so many deals, and if for every conversation we have, if people want us to sign an NDA before we have an initial conversation, we would just tie ourselves in knots, basically. So effectively, as I was saying, when you look at our process, we're looking for an application, then the pitch, and then we'll sign an NDA, because at that point, we're going to start looking under the covers of the business a bit more. If you're nervous about things you need to give away prior to that point, there's probably 2 things I'd say. The first is, I actually wouldn't worry about it. The reality is, it's not the IP and the initial business idea that is the thing that's going to make you money. It's actually the execution of that. And there is very few stories of an idea that's been leaked that someone goes faster at executing, and that. So I wouldn't be too worried about that. There are obviously certain industries and a few businesses where that early IP and holding it close is really important. And I do appreciate that, not to undermine what I was just saying before. But if that's the case, then we're still not going to sign an NDA because we won't know till we get to that point. You're just going to have to think about, how do I give enough information in the application that I'm comfortable with and in the pitch to get them interested to the point of then being able to sign an NDA. But if someone's really cagey and it's like, I can't share it with you, sign something. We have so many deals, we actually just won't progress. It's like, okay, that's fine. But clearly, if you don't trust us right now in initial conversation, that's just a bad foot to start on anyway. So I know that's kind of probably harsh to hear, but it is a bit of the reality of the venture industry.
Mm-hmm. The next question is around the commitment and something that you mentioned around full-time commitment being a non-negotiable from the founders. The question relates to whether it refers to before you invest. What if investment is necessary to actually enable the founders to focus full-time? Again, that's a tricky one that it's a bit of a balancing act that we do come across from time to time.
Yeah, totally understand. It's a great question, actually. Look, I think we actually really like the bootstrapping model. So if you've been hustling and building your business on the side or a couple of days a week or in the evenings, and it's suddenly got to a point where this is about to take off and you need capital, and it's that capital which is the catalyst for you to go full-time into the business, that's okay. We're very happy to support that if we agree that that's the right trajectory. I guess what I'm more talking about is where people have got multiple ventures and things and they're not focused. I think this question is more around, whether we would support that. So we've definitely done that before. And in fact, to the point that if we were investing, usually because of the check size that we write, if the founder wasn't full-time in the business, but was wanting to, we would almost enforce that in the sense of, because sometimes founders go the other way and go, it's okay, I'm going to take a smaller salary and I'll only work 3 days a week to not put too much pressure on the business in the early days. Because we're like, we'd rather take that pressure off you, even if it's a modest salary, make sure that you're in there full time. We don't want you worried about your own personal cash flow issues. Outside of that, we want you to kind of be involved in building that business as fast as you can. So, often our capital is there to support that, which is okay.
Okay, makes sense. Valuations. So valuing early stage startups can be tricky, particularly if they are pre-revenue. Would you consider a safe agreement, so simple agreement for future equity, or a convertible note as an alternative to a price round?
Yeah, sure. Again, great question. So I think if you listen to what I was saying before, I don't think that it's difficult to value startups. We actually have a methodology around that, probably not the time to explain that in detail, but just as I was saying, it's as much around attributing value for the milestones that you've hit, and then it's agreeing to a business model that we would apply some more traditional metrics of bringing that business model back into today's terms and looking for comparative metrics of what the valuation might look like. That said, doesn't always mean that it's easy, but I think there is a method to do that. Of course, this question then is around, would we consider a safe agreement or convertible note? And so the answer is no, but the reason it's no is because a safe note is actually around the fact that the founder and or the investor can't agree on valuation. And so we're going to give you the money and then we'll take a discount on a valuation down the track, which someone else might apply. But the way we look at that is going, well, if we can't agree valuation right now, we probably got off on the wrong foot on our ability to agree on difficult conversations. And so a safe note is actually avoiding the hard conversation to agree that. And for me, that's actually a really important part of the due diligence process to make sure that we can have hard conversations and reach some level of agreement. And the safe note actually takes that away. Where we would invest in a safe note is what we've done in the accelerator program that we've invested in. But the reason for that is we're investing in 15 companies potentially at exactly the same time in a 6-month program. And what we don't have the ability to do is negotiate with 15 companies in 1 week to determine the valuation. So the safe note there is a pretty founder-friendly set of terms that means we can just efficiently get money to those companies. That's kind of a different scenario. But outside of that, we wouldn't invest in a safe note and con note. And even, again, we've had people come and that's the way they want to structure the round. And before we even get into DD, we just say, look, that's fine. We understand why you might want to do that, but that's not a mechanism that we invest. So for us, it's capital in for a straight equity deal, keep it simple, make sure we're agreeing on the value of the company, the plan of the company, and then we can go forward from there.
Kind of refers back to those 3 C's if you're not agreeing from day one.
Exactly. Yep, that's right.
Just a question on which relates to the investments that you made so far. So the 4, almost 5 investments that you made so far, and I don't know whether it's something you can answer, but just interested to hear whether they are at this point straight investments, or you're working with those companies in any other way, either through the fund or through RAC more broadly, or there's plans for that more strategic alliance in the future with any of those businesses.
Sure. Bar one of the companies, all of the others, we sit on their board. We tend to do that as what we call an observer role. So typically when we make an investment, it's because we're investing early stage, it's very likely that we're the largest financial investor in, and we typically lead and price the round. Because of that, we list out a number of business decisions that we like to be involved in. But everything outside of that, we're trusting the directors to make the decisions. But what we do is we make sure that we get to sit in on the board meetings and just to add value and apply governance. And it's not, I guess sometimes that feels like, oh, you're trying to control, but it's actually the opposite. We're trying to create a governance structure that allows you to go for it and have other heads around the table. When I was running my company, it was interesting. The moment we put in a board that had someone on it that wasn't in the day-to-day of the business, it's when we actually started accelerating our growth. And even though we got to make all the decisions, it was interesting when you have to show up once a month and talk about, we said we were going to do this, we did it or we didn't, or we got stuck here and we need help, and or we've done really well and we're building momentum and we want to share the stories. It's amazing how just that monthly catch up really impacts that. So definitely the board is something that I think we add value to, and we've done that with most of the companies. We've then got one which so we have a magazine that goes to all the members in WA. They've been able to advertise in that, and we're just working through at the moment whether they might also offer a member benefit. So again, that gives them exposure to the member base, but the members get like a 5% discount on the product or something like that if that was to progress. So that's the kind of other value that we would like to offer.
Mm. Yeah, that's great. So I think we've, thank you for all your questions in the Q&A. What I do want to say now, and I think I've mentioned it previously, is that we will follow up in the email to all attendees, just with details of the website, which Derek, I think you've also posted in the chat group as well. And that obviously will have a link to the application process for those that feel that they may be ready for that. And also just post any other follow-up details that we will get from the team afterwards. So on that note, I'd like to just say a huge thank you to James and to Derek for your time and your insights into the fund, but also just more broadly the process of applying to raise capital. I think I speak for everyone that it was a really helpful session. Thanks to RAC as well, again, for your support and your ongoing support, and to the whole team at BetterLabs as well. As I said, we'll follow up with a little more information for you. From our end, just to reiterate that we have got some events happening in July, and we'd love to see you all there as well. Firstly, for the launch of the EY Australian Ecosystem Report, Insurtech Ecosystem Report, as well as the DXC Insurtech Invitational, which will be a pitch event, a virtual pitch event for the first time over the last 3 years, which should be very interesting. Please do get in touch with us or sign up to our newsletter if you're not already, or if you want more information about membership, partnership, or anything else that we do at Insurtech Australia. Please don't hesitate to reach out, and hope to see you online at the next virtual event. Thanks, everyone.
Excellent. Thank you.
Thank you.